Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Imagine trying to run this highly regulated financial empire where 80% of your frontline workers aren't even actually your employees.
Right. It sounds impossible.
Yeah, I mean, we are talking about herding over 8,000 highly paid, totally independent cats, all while operating under one of the, strictest regulatory microscopes on Earth.
Which is usually a recipe for just a massive corporate headache.
Exactly. But here is the wild part for you to wrap your head around. Those independent operators, they are currently generating over $1.2 million in revenue each. Every single year.
Yeah, and it completely flips the traditional Wall Street script on its head. I mean, when you look at the standard wirehouse model, it's always about top-down control.
Always.
But this decentralized approach they're taking, it's yielding a return on equity in the mid-50s, like mid-50% range.
Yeah.
That is an astonishingly efficient use of capital.
And that is exactly what we are unpacking today for you. We've got our hands on this really comprehensive research report by Compasscope alongside the Q2 2026 earnings call transcript for Ameriprise Financial.
Right, stock symbol AMP.
Yep, AMP. And our mission for this deep dive is to really look under the hood of this advice-led financial giant, figure out the plumbing, how they actually make their money.
And whether this unique structure can survive a market that is just getting squeezed by high-tech disruptors on one side and then legacy Wall Street titans on the other.
Exactly. If you're an investment enthusiast who wants the ultimate shortcut to understanding a major financial stock without drowning in jargon, this is for you.
It's a fascinating case study because Ameriprise, they aren't playing the same game as a pure investment bank or, a discount brokerage.
Right. You can't just look at the stock ticker and get it.
No, you have to break down their four major pillars to really see how the gears interlock.
So let's start right there with the business lines. Because if you don't understand the ecosystem, nothing else about Ameriprise makes any sense at all.
Totally.
The beating heart of the whole operation is their advice and wealth management division.
Right, the AWM.
Yeah, the AWM. That's the army of about 10,600 financial advisors we just mentioned.
And that advisor network is really the funnel for everything else. Like, the second pillar is asset management, which operates under the Columbia Threadneedle brand.
Okay, so Columbia Threadneedle.
Yeah, they're the manufacturing arm. They build the mutual funds, the exchange-traded funds, and the separately managed accounts.
Wait, just to make sure we're all on the same page here. Those separately managed accounts, the SMAs, they are essentially custom-built portfolios for a single investor. Right?
Exactly.
Unlike a mutual fund where your money is just sort of dumped into a giant pool with thousands of other people, an SMA gives an affluent client direct ownership of individual stocks with tailored tax advantages.
Precisely. It's a much higher margin, stickier product for the firm. Then you move to their third pillar, which is retirement and protection solutions.
Which is basically their RiverSource brand.
Right, RiverSource. This handles the life insurance and the annuities. And then finally, you have Ameriprise Bank.
Which is growing pretty fast, right?
Oh, rapidly. It's a growing banking franchise offering checking, mortgages, and pledge loans.
Okay, let's unpack this ecosystem. Because looking at how these four pillars interact, I'm getting serious Apple vibes.
Oh, really? How so?
Well, think about it. You walk into an Apple store and you buy the iPhone. That's the entry point. In this scenario, hiring a human Ameriprise advisor is the iPhone.
Okay, I see where you're going.
Right. But once you have the phone, it is just so incredibly easy to buy the Apple Watch, which is Ameriprise Bank.
Right.
And then you subscribe to Apple TV, which is Columbia Threadneedle. Is that kind of the underlying psychology of this business model?
That analogy holds up incredibly well. But I'd add one critical caveat.
What's that?
With Apple, the ecosystem is held together by software. At Ameriprise, the ecosystem is held together by human trust.
Oh, wow. That's a great distinction.
Yeah, the advisors aren't just out there selling standalone checking accounts or random mutual funds. They are doing really deep, holistic financial planning.
And the Compasscope report highlights that this cross-pollination generates over $1 billion in annual intersegment revenue, right?
$1 billion, exactly. Because once the advisor has your trust, moving your mortgage to Ameriprise Bank or, populating your portfolio with Columbia Threadneedle funds, it just feels like a natural, frictionless next step for the client.
Which brings up a really interesting structural question, Freddie.
Sure.
If Columbia Threadneedle is manufacturing these great asset management products, couldn't they just sell them on the open market? Like, why are they so reliant on this human advisor iPhone to drive the ecosystem?
Well, I mean, they certainly do sell their asset management products externally to institutional clients, but their true, undeniable competitive advantage, their moat, really is captive distribution.
The captive distribution.
Yeah, because in the open market, Columbia Threadneedle is competing against behemoths like Vanguard and BlackRock.
Oh, right, which is just a race to the bottom on fees.
Absolute bloodbath of price wars. But within the Ameriprise ecosystem, they have direct proprietary access to wealth clients through those 10,600 advisors. It is a built-in, highly lucrative customer base.
So the human advisor really is the linchpin. Like, if Ameriprise loses the advisor, the client leaves, the bank deposits dry up, and the asset management fees just vanish.
Exactly. Everything falls apart.
So how exactly do they defend this moat? Because every other financial firm on earth knows this, and they all want those advisors.
What's fascinating here is how they defend it with massive switching costs.
You're right, the friction.
Yeah, in finance, switching costs are the friction, the paperwork, the sheer headache involved in moving your money or your practice to a new firm.
It's notoriously awful.
It is. Ameriprise makes its ecosystem so sticky that an advisor's retention rate sits at around 93% over the last decade.
93%.
Yeah, and the average tenure of an Ameriprise advisor is over 14 years.
14 years is an eternity in modern finance.
Really is.
But is that just because the paperwork is annoying, or is there a bigger strategic advantage keeping them there? Because when I look at the competitive landscape, it's brutal.
Extremely brutal.
You have the wirehouses like Morgan Stanley and UBS who completely own the ultra-wealthy, the $10 million plus family office crowd.
Right.
Then on the other side, you have places like LPL Financial offering totally open architecture. Like LPL tells advisors, come here, sell whatever you want. We won't push proprietary bank or insurance products on you.
Exactly.
So where does Ameriprise actually fit into this spectrum?
They sit very deliberately in a highly specific middle ground. Their average client asset size is around $300,000.
Okay, $300K.
So they're squarely targeting the mass affluent market. They are not trying to lure away a billionaire from Morgan Stanley, but they're also a huge step up from, a basic retail brokerage account.
But here's where it gets really interesting to me. Isn't that $300,000 client exactly who the low-cost robo-advisors are hunting?
Yes, absolutely.
Because a Silicon Valley tech firm might look at that demographic and say, hey, we can automate a diversified portfolio for a fraction of a percent. You don't need to pay a human advisor at Ameriprise to do this.
Right. They make that argument all the time.
And those mass affluent accounts aren't shielded by the massive complexity of a billionaire's estate plan.
Yeah.
That feels like a massive vulnerability.
It is absolutely a threat, and Compasscope actually flags client tiering as a core competitive challenge.
I thought so.
But Ameriprise's defense mechanism against the robo-advisor isn't asset allocation. It's comprehensive life planning.
Okay.
Because a client with 300 grand still has messy, uniquely human financial anxieties.
Sure, they're worried about funding their kids' college or navigating taxes or deciding when to take Social Security.
Exactly. A robo-advisor can automatically rebalance your portfolio, sure, but it can't sit across the table and talk you off a ledge when the market drops 20%.
Right, the algorithm doesn't hold your hand.
Nope. And Ameriprise provides its franchisees with a proprietary tech stack that makes doing that deep dive financial planning highly efficient. So the advisor stays because the tech is great, and the client stays because the advisor is managing their entire life, not just their stock picks.
Got it. So if the moat is secure, if they are successfully holding off the wirehouses at the top and the algorithms at the bottom, how do they actually grow? Like, what is the roadmap for Ameriprise moving forward? Because it doesn't sound like they're just trying to blast ads on television to sign up 1 million random new retail clients.
You're right. They aren't playing the mass acquisition volume game. If we connect this to the bigger picture, their organic growth strategy is hyper-focused on squeezing more productivity out of the system they have already built. Specifically, they are pushing for a sustained 10% annual growth in advisor productivity. They want the advisors they already have to handle more assets, and they're using AI tools to free up the time required to do that.
And while the advisors are freeing up their time to gather more assets, the corporate side is pushing cross-selling really hard, right?
Oh, very hard.
Because the data shows that practices utilizing the Ameriprise Bank solutions end up managing about 10% more assets overall. It just sinks the hooks deeper into the client.
Exactly.
But they're also making some structural shifts to their product lines, too. I noticed they are heavily emphasizing capital-light insurance products.
Yeah, that is a crucial part of their margin strategy right now.
How so?
Historically, traditional life insurance and annuities
Yeah.
required massive, heavy capital reserves. You were promising a client a guaranteed payout in 30 years, which meant regulators required you to hold billions of dollars in cash today, just in case.
Right, dead money sitting around.
Exactly. By shifting to capital-light products, Ameriprise shifts a lot of that underlying market risk back to the client, or they reinsure it. That dramatically frees up their balance sheet.
Which unleashes tremendous free cash flow.
Yes, it does.
And this is where their real financial engineering comes into play, doesn't it? According to the roadmap, they are planning to take all that freed up cash and return 90 to 95% of their net income to shareholders over the next 5 years.
Heavily leaning on share repurchases, yes.
It's an incredibly aggressive capital return strategy, and it completely dictates their financial profile.
It really does.
So, what does this all mean? Let's break down the mechanics of that for a second, because it's kind of brilliant. Are they basically engineering their EPS growth financially by aggressively buying back their own stock rather than relying purely on top-line revenue from new sales?
I wouldn't call it engineering in a pejorative sense, but rather a mathematical reality of a high cash flow, high ROE business.
It's like owning a pizza with 8 slices, and you slowly buy out your partners until it's only a 4-slice pizza.
Exactly.
Even if the pizza itself didn't get any bigger, even if your top-line revenue only grows modestly, your personal slice just doubled in size.
And that's how Ameriprise is creating a 12 to 15% compound annual growth rate in earnings per share, or EPS, on just single-digit revenue growth.
Yeah.
They don't need to reinvent the wheel. They just need to run the machine efficiently and shrink the float.
But, every machine has its breaking point.
Well, of course.
If the master plan relies on squeezing more efficiency out of the system and aggressively buying back stock, we have to look at the execution risk. What are the speed bumps that could throw this well-oiled machine off course?
Well, the most immediate speed bump is the recruiting environment, which management explicitly called irrational right now.
Irrational.
Yeah, there is an absolute arms race for advisory talent across the industry. Competitors are throwing staggering upfront checks to lure top teams away, sometimes offering cash deals that take up to 8 years to pay back.
Wait, 8-year paybacks? That means the competitor taking the advisor won't even see a true profit on that move for nearly a decade.
Exactly. It's a complete land grab.
Yeah.
Ameriprise has drawn a line in the sand and refuses to match those irrational deals because it destroys long-term shareholder value.
I mean, the discipline is admirable.
It is economically brilliant in the long term, but in the short term, it creates execution risk as they watch competitors successfully buy market share.
It's a classic Wall Street dilemma, right? Do you want to look good this quarter or be profitable this decade?
Precisely.
But I want to circle back to something we touched on earlier, which feels like a massive structural risk. The franchise model.
Yes.
Wait, if 80% of their advisors are independent franchisees, doesn't that make maintaining a consistent brand standard almost impossible? It sounds like they are trying to herd 8,000 highly paid independent cats.
That is the tightrope they walk every single day. The compliance and supervisory risks are immense.
I can imagine.
If an independent franchisee operating in a strip mall in Ohio goes rogue, gives terrible financial advice, or mishandles a client's funds, it still says Ameriprise on the door.
So the reputational damage flows straight up to the parent company.
Exactly. They have to oversee thousands of decentralized offices, ensuring every single one is meeting fiduciary standards, which gets incredibly tricky when those same advisors are economically incentivized to recommend proprietary Columbia Threadneedle products.
Oh, wow. Yeah, regulators love to scrutinize those exact conflicts of interest.
I absolutely do.
And speaking of Columbia Threadneedle, the asset management side isn't immune to risk either. The report mentions they are facing some heavy structural headwinds.
They are. About 55% of Columbia Threadneedle's assets under management are in traditional active equity.
Okay.
The problem is the entire financial industry is experiencing massive secular outflows from active management.
And just to clarify, by secular outflows, we mean a structural, long-term migration of money away from expensive mutual funds managed by stock pickers and toward ultra-cheap, passive index funds that just track the S&P 500.
Precisely. It's a tide that is very difficult to swim against. and it leads directly to fee compression.
Because investors realize they can get market returns for a fraction of a percent with an ETF.
Right. Active managers are being forced to slash their own fees just to stay relevant. So Columbia Threadneedle is trying to grow revenues in an environment where the underlying product is getting cheaper across the board.
Wow.
Add in the fact that their entire value proposition to franchisees relies on a proprietary tech stack, meaning a single cyber attack or data breach could shatter the ecosystem, and you have a fairly complex risk profile.
Okay, so we have this tug of war. On one side, a highly disciplined, sticky ecosystem throwing off massive cash. On the other side, an irrational recruiting war, massive compliance hurdles, and secular fee compression.
Yep, that's the battlefield.
To see who is actually winning this fight, we have to look at the scoreboard. The Q2 2026 earnings call. How did the machine actually perform?
In a word, spectacularly.
Really?
Yeah, it was a record-breaking financial print. Total revenues hit nearly $5 billion, which is a 13% increase year over year.
13%, wow.
Their EPS jumped 22% to $11.07, and total assets across the firm reached a staggering milestone of $1.8 trillion.
So that EPS math we talked about is clearly working.
It's humming along perfectly.
But earlier we mentioned their organic growth relies on squeezing more productivity out of the advisors using AI. Did the earnings call provide any hard evidence that this isn't just, corporate buzzword bingo? Like, is the tech actually moving the needle?
The metrics they released were quite striking, actually. They reported that advisors utilizing multiple integrated AI tools are saving more than 30 hours a week.
30 hours? That's almost a whole work week.
Right. They broke it down. 10 to 20 hours saved from automated e-meetings, 5 to 10 hours from meeting summarization software, and about 2.5 hours using a centralized co-pilot feature.
But wait, how does that work in a highly regulated environment? If I'm a client discussing my estate plan, my social security numbers, all my deep financial anxieties, the advisor can't just dump all that sensitive data into a public version of ChatGPT to summarize the meeting. The compliance risks would be catastrophic.
You're entirely correct, which is why the execution of this tech is so vital. They aren't using public open source AI models.
Okay, so it's internal.
Yes. The 30 hours of time savings come from proprietary closed-loop AI systems trained specifically on financial services data and housed within Ameriprise's secure, compliant infrastructure.
Oh, okay.
It handles the transcription, categorizes action items for the client's file, and drafts follow-up emails, all while keeping the data walled off from the outside world.
Getting 30 hours a week back from AI is literally like giving every advisor a free, highly secure, full-time administrative assistant.
Exactly. It's a massive operational advantage.
But while the retail advisor side is humming along with AI assistance, the institutional side of the business had some serious drama in Q2, right? Let's talk about the AFI channel. This is where Ameriprise provides the wealth management backbone for other regional banks.
Yes, the institutional channel.
What exactly happened with Comerica and Huntington?
Well, this raises an important question about that channel. It was a quarter of wild swings. They announced the acceleration of a lost relationship with Comerica Bank, which means about $19 billion in assets will be leaving the platform by Q3.
$19 billion out. Ouch.
Right. But simultaneously, they are preparing to onboard Huntington Bank in Q4, which is going to bring in 260 advisors and $28 billion in fresh assets.
I mean, but looking at this Comerica out and Huntington in situation, is this institutional business just a leaky bucket where they constantly have to hustle to replace giant clients? It sounds less like a stable wealth management pipeline and more like whale hunting.
Whale hunting is the perfect way to visualize it. The AFIG platform is incredibly lucrative when you land a Huntington, but it creates massive, lumpy asset flows.
And Wall Street hates lumpiness.
Despises it. If the timing is slightly off between a whale leaving and a whale arriving, your quarterly asset flows look terrible to analysts. It really highlights that while institutional partnerships are great for scale, they are inherently far less sticky than a 14-year relationship between a single human advisor and a mass affluent family.
That makes total sense. And despite the whale hunting volatility, they didn't take their foot off the gas regarding their capital return strategy, right?
Not at all. They aggressively executed their playbook. In Q2 alone, they returned 91% of their operating earnings to shareholders.
Wow.
That included buying back 1.7 million shares at an average price of $459 each.
Okay, so we've got a record $1.8 trillion in assets. The AI productivity engine is proving out, and they are executing their buybacks flawlessly. But as we look toward the horizon, What are the specific keys that dictate whether this machine keeps humming or grinds to a halt? What should we be watching?
The first, and frankly the most dominant key, is the trajectory of the broader equity markets. Because the vast majority of Ameriprise's fees are calculated as a percentage of assets under management, they are deeply tethered to market performance.
So a prolonged bear market doesn't just hurt their clients' portfolios.
No, it directly shrinks Ameriprise's top-line revenue and crushes their margins.
Okay, what else?
Second, you have to monitor the recruiting wars. Will the irrational 8-year paybacks cool down, or will Ameriprise eventually be forced to capitulate and spend heavy capital just to keep their headcount stable?
And what about the interest rate environment? Because we really can't talk about a company operating a major bank without addressing the Federal Reserve. How sensitive is Ameriprise to rate cuts?
This is where understanding their exact revenue mix is crucial, because many competing brokerages rely heavily on something called cash sweeps to drive their profitability.
Right, and just to clarify for everyone listening, a cash sweep is basically when a brokerage takes the uninvested cash sitting idly in your account, sweeps it over to an affiliated bank, and lends it out or parks it in higher-yielding bonds.
Exactly.
The firm pays you a tiny fraction of a percent in interest, and they pocket the massive spread. Some firms absolutely live and die by that spread.
And when the Fed cuts rates, that spread vanishes, and those firms take a huge earnings hit. But there is a critical nuance in the Ameriprise earnings call. More than 70% of their earnings are core fee-based.
Ah.
They do not rely on cash sweep margins nearly as much as their peers.
Okay, let's unpack this. So if the Fed aggressively cuts rates, Ameriprise is actually pretty well insulated compared to a wirehouse that relies on sweeping client cash.
Yes.
But the double-edged sword is that because they rely so heavily on core advisory fees, if the S&P 500 tanks, their entire economic engine stalls out instantly.
That is the precise trade-off.
Oh.
Their earnings are exceptionally high quality, but they're inextricably linked to the rising tide of the broader market.
What a phenomenal breakdown. So let's recap this journey. We started by looking past the corporate logo to reveal a sticky, interlocking ecosystem driven by human advice.
The iPhone and the Apple Watch.
Exactly. We saw how they've built a protective moat around their mass affluent clients, generating incredible $1.2 million per advisor productivity while fighting off Wall Street titans and robo-advisors alike.
Yep.
We unpacked their strategy of using capital-light products to fund a massive share buyback engine, and we saw the hard evidence in Q2, a 55% ROE and AI tools fundamentally changing how many hours an advisor has in their day.
It really serves as a masterclass in the power of captive distribution. I mean, they aren't trying to be all things to all people. They're just running their specific mass affluent playbook with ruthless efficiency.
They really are. But as we step away from this blueprint, I want to leave you with one final provocative thought. We've talked extensively about how Ameriprise is successfully arming its human advisors with incredible, secure AI tools to automate 30 to 40 hours of complex financial planning tasks every single week.
It's an amazing leap forward.
It is. But if those AI tools continue to evolve behind the scenes, becoming exponentially smarter, more intuitive, and more conversational, how long until the mass affluent client eventually realizes they could just interact with the AI directly? Will Ameriprise eventually have to completely reinvent the value proposition of a human advisor? Or do they risk becoming obsolete to the very technology they are currently championing? It's something to chew on.
Truly.
Thank you for joining us for this deep dive into Ameriprise Financial. We hope you walk away with a much clearer picture of how this ecosystem actually operates. Keep questioning the mechanics, and we will see you next time.
This content is produced by Compasscope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.